Hey everyone, in this video I've got one growth stock that's down 42% off the high that I think is an extremely good value right now at current prices. So in this video I'll reveal what the growth stock is, why I like it so much, including its revenue growth, valuation, and profitability, and then I'll look at valuation in comparison to all of those factors to close the argument on why I like this growth stock so much. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Alright, so the growth stock that I'm talking about in this video is Pinduoduo, ticker symbol PDD, and it's down 41.76% off its high. Now let's look at the recent performance as a reason for one of the reasons why I like this growth stock. So in its latest quarter, total revenues increased by 94%, while operating profit increased by 60%. The company is nicely profitable, generating 2.282 billion US dollars in operating profit compared to 9.435 billion US dollars in revenue, so a significantly solid operating profit margin. Net profit also increased by 47% in the latest quarter. The company's revenue has been exploding in recent years to 28.07 billion. That's up from a little less than 4 billion in 2019. The company's e-commerce segment is growing rapidly, especially overseas. You might be aware of its Temu brand, which is expanding in the US. It already has over 100 million active users. And if you've shopped on the platform, you probably realize it's got really low prices, especially when you compare with Amazon. I've got an example here. This non-branded Apple Pencil sells on Amazon for roughly $20. I was able to get this for $7 on Temu. And that's just one example of several items I've found on Temu that are significantly lower priced compared to Amazon. Now on Temu, you don't get that fast and free shipping like you do on Amazon, where a lot of items can be delivered next day or in 2 days. But if you order above a certain amount, let's say $25, you do get free shipping on Temu as well. I'm not sure if that value is $25 or a little bit higher, but you do get free shipping after a certain amount. And then there's a lot of items that, like that Apple Pencil, I don't need right away. And so I'll buy it on Temu because I don't need it right away. I don't want to pay double the price just because I'm going to get it in 2 days instead of getting it in 6 days, right? And so that's one of the reasons why Pinduoduo's Temu is gaining traction, is because of those lower prices. And you could see that here, 28.07 billion in revenue. That's significantly higher than where revenue was in 2019. More importantly, Temu or Pinduoduo is demonstrating economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from $100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. And so you can see the importance of that metric. It's up to 22.84%, up from negative 75% in 2019. Furthermore, if you consider the cash flow from operations, cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of % annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. Now that you understand how that's different from operating income, that's also improving and solid at 42.5%, up from a bottom of 24% in 2022, but it's also been up above 48% in 2019-2020. So you can see the potential of this business model is significantly lucrative. And all this you can buy at a forward price to earnings ratio of just 12.4. That's ridiculously cheap. Now, there's a reason why it's cheap. Geopolitical concerns with companies based in China are a big factor. If this was a US-based stock, it would be trading at least for twice the valuation. You would not be able to buy this stock with these characteristics, this kind of profitability, this kind of revenue growth, and this kind of a hot product with just this valuation. You would have to pay probably a forward price to earnings of above 30, probably closer to 40. So you're getting this stock at roughly 1/3 the valuation it would be if it was a US-based stock. So for all these reasons, I think Pinduoduo is an excellent growth stock that's got geopolitical concerns that I think are over-factored into its valuation right now. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.